appreciate this opportunity. So I put some material together that I'd like to share with you guys today on our Terra UST analysis. We've been spending a lot of time analyzing different stablecoins, XREX. We mainly focus on accelerating financial inclusion in emerging markets. India is our largest market, followed by the Middle East, Africa, and Southeast Asia. So it's this issue is very close to us. And this morning, I saw a report, a story, describing that we have a lot of exactly the type of people that XREX is servicing. So an example, Argentina, they're ranked world 31st in GDP, but their money depreciated 2,400% over the past 10 years, right? So these people, stablecoins, especially US dollar pegged stablecoins, are super useful to them. But very unfortunately, they were looking for stability when they started using UST, and now they have nothing. So a whole genre of algorithmic stablecoins are implemented using the two token model that was proposed by Robert Sams back in 2014. So I'll explain. And Luna falls in this category. So Robert Sams, when he wrote the paper, he's talking about Bitcoin, right? So he says, well, Bitcoin, it's a great new type of money and everybody's using it, but there's two forces at play that defeats Bitcoin's original vision of becoming a unit of count, because Bitcoin's volatile. Why is Bitcoin volatile? Because you have one force that are the users of Bitcoin that are holding Bitcoin for transaction, right? And as more and more transactions happen, you then have another force, which is the speculators, investors and speculators that are speculating against future transactional demand of Bitcoin, right? So the speculators are saying, oh my God, there's, Bitcoin transactions growing. So many people are using Bitcoin for all sorts of transactions. And therefore, future transactional demand of Bitcoin is going to go up and up. And therefore, how do we capture this opportunity? How do we get in? Then we should buy and hodl Bitcoin, right? So they buy and hodl Bitcoin. But as they hodl and sell Bitcoin, this causes Bitcoin's price to go up, right? Because people hodl. But then this defeats the original purpose of Bitcoin as a stable unit of count. And as Bitcoin's becoming more and more successful, you have more and more investors and speculators that are hodling, and this further introduces volatility. And so Robert Sams then back in 2014 proposed a two token model. And he said, look, let's just have one coin that's stable, that's being used as unit of count. And it's always stable in value and purchase power. And we're hoping that it doesn't go up and it doesn't go down. But if this coin is successful, definitely we're going to attract a lot of speculators and investors. So what do we do? Well, then as this new money, this stable coin is becoming more and more successful, the money operator, this whole system must be generating a lot of transaction fees, right? Generating a lot of profits. So let's then give these profits to another share, to investors as dividend, and we account for this ownership by another class of shares called seniority shares. All right, so seniority shares are you hold seniority shares to receive dividends from transaction fees of the successful stablecoin, right? This way, you can really divert the two forces to hold on to different coins. For users that need to use this coin for transactional purposes, well, you hold on to the stable coin. And when you don't need it, you dump it. And for people that are speculating and looking forward to benefit from all of the profits generated by the growing transactions of this system, you hold on to the seniority shares. Okay, so this is the two token system. And in Terra Luna, we have UST as the US dollar pegged stablecoin, and we have Luna, which is the signature satisfying the speculative demand. So I got some. Okay, so and there I picked out 3 algorithmic stablecoins that, and I call them algorithmic stablecoins. Nowadays, people call DAI over collateralized stablecoins, but before they were all called algorithmic stablecoins because most of their mechanisms are implemented in smart contracts. So I picked out 3 because I feel they represent the spectrum. So the first one, which is the very original one, is DAI. So DAI have MKR as their governance token, and then they have DAI as their US dollar pegged stablecoin. Initially, DAI was 100% backed by ETH. So if we look at ETH, what's ETH? ETH is an asset used as DAI's collateral, and it's exogenous to the MakerDAO ecosystem, meaning that no matter if MakerDAO, the stablecoin protocol, is doing well or not, this doesn't affect ETH, right? At the same time, ETH volatility, like for example, if ETH's been depreciating, is not reflecting the fact that MakerDAO, the stablecoin protocol, is not doing well. Okay, so it's exogenous to the system, to the money system, which is great because then it's not, it's not, you don't have an asset that's correlated directly to the money success. But it is, and that's spelled wrong. Sorry, it is endogenous. So the second column should be endogenous. It is endogenous to crypto markets, right? So meaning that it's still there's still some correlation in that if MakerDAO as a DeFi protocol is not doing well because we're in a bearish cycle as we're in right now, then as their governance token MKR depreciates, ETH, the main collateral type, is also going to depreciate because ETH and MKR and the whole MakerDAO ecosystem are all in the crypto market, right? So according to this analysis, then the risk segregation score for DAI, when it's having ETH as collateral, is 1 out of 2. And also because of this, DAI was never able to peg extremely well to the US dollar until January of last year, when they introduced USDC as another collateral type. And now USDC is over 51%, right? So now you have DAI collateralized over 51% by USDC. Now DAI pegs really, really well. So if we look at USDC, yeah. So the chart is right. So sorry. So USDC is both exogenous to the MakerDAO ecosystem. It is also at the same time exogenous to the crypto market, right? So USDC is going to hold its peg. Why? Because it is collateralized by cash and cash equivalent. So no matter how deep crypto markets crash, we'd expect USDC to hold its peg. So USDC, when used as a collateral type for the MakerDAO protocol, is both exogenous to the money system as well as exogenous to the crypto market overall. So it is a really good collateral to use. And so it has a score of 2 out of 2. If we look at FRAX, FRAX is an interesting protocol where FRAX asks the question, well, does it have to be 100% exogenous, right? So FRAX said, well, look, guys, so let's start with USDC because USDC is exogenous to our system. It's also exogenous to crypto markets. So it will acquire us a lot of confidence. So let's start with that. But let's ask the question, if we continue to build really important applications of our stablecoin, FRAX, will the market allow us to have some endogenous collateral which is our own FXS governance token, right? And so let's build solid use cases for our stablecoin, and so that our stablecoin versus USDC is going to have a premium. And if it has that premium, then algorithmically, we're going to adjust the ratio so that we introduce some endogenous collateral or reserve type, which is FXS, right? And so here, let me explain a little bit. So you may be wondering, well, if DAI is over 50% backed by USDC and Frax is over 87% backed by USDC, why create these stablecoins in the first place? I mean, what's the difference between users just holding USDC? Well, there's huge difference. And the difference is in the application, right? For example, if Frax built all these really deep liquidity pools on Curve, and whenever you want to trade Bitcoin and you want to trade very large ticket sizes of Bitcoin, the only good pool that you're going to find is going to be the Frax pool. Then you're going to trade against that pool, and therefore you're going to need a lot of Frax, right? So yes, maybe in their store of value, they're pretty much the same. They're all US dollar pegged, but in their actual application, every money is very different. And so that was Frax's strategy. And it's an interesting experiment over their existence. I think they existed for about 3 years. They're not able to get that FXS ratio for to over 13%, right? So we read two things here. One, the market recognizes Frax efforts and has given them a premium, so that they don't need to be 100% collateralized by exogenous assets only. But at the same time, the market never gave them more premium than 13%. So that's kind of the equilibrium for Frax right now. So Frax sits right in between DAI and UST. Both, all of these are based on Robert Siem's dual token model. So UST, Terra UST is 100% supported by Luna, which is endogenous to the money protocol, as well as endogenous to the crypto market, right? So it's exogenous to either, and therefore it's really easy to death spiral. In the past half year, they've introduced an extra layer of protection, which is Luna Foundation Guard's BTC reserve. They had about roughly 3 billion worth of BTC. And we look at this, so roughly about 15 to 17% of their money supply. They have this defense budget. And BTC is exogenous to the Terra Luna ecosystem. So it has some square there, but it is still not exogenous to crypto market, right? So as crypto markets fall and we enter a bear cycle, this is precisely when the defense budget is going to be super important. This is the time that many of these stablecoins are having huge potentials to depeg, and when you would need to sell those Bitcoin, but then this is precisely the time that Bitcoin is also going to be going down and depreciating in value. All right, so based on these analysis, we gave stability scores to these three pretty significant different types of quote unquote algorithmic DeFi stablecoins. And we'll just throw centralized stablecoins in here, USDC and USDT. They're both collateralized by cash or cash equivalent. So their collateral is exogenous to both their own business and exogenous to crypto markets. So it is, in our opinion, so far, perhaps the best type of collateral, although centralized, but we're just talking about, from a reserve quality standpoint, they're the best type of collateral from a reserve quality type for DeFi stablecoins. Okay, so we switch to look at another another front, we look at centralization versus decentralization. The US dollar is completely centralized, right? It's hard to get visibility into the US dollar. It's hard to know how much how much we're issuing, how much brought money we have. It's just there's no visibility. Fed makes the decision. So the ledgers centralized, the operations of the US dollar centralized, decision making of the US dollar also centralized. So decentralization level 0. And then we look at first generation centralized stablecoins, and they're not completely centralized, right? The ledger is decentralized because they're all minted on the chain, and that's why when the Russian-Ukraine war broke out, all of us were analyzing the flow of these stablecoins, and obviously some types of stablecoins were getting accumulated by Russian exchanges, and some types were getting dumped, right? So there's a clear preference, and why we can analyze this is because their ledger is decentralized. And recently, we all know that USDT has been redeemed for about maybe 10 billion. So they're down from, I think, like 85 to 75 in total outstanding tokens. And this is because of market fear and redemption. And we can analyze all these things because at least their ledger is decentralized. Operation, how do Circle and Tether manage their reserves? We don't know. We have no idea, right? How they run their operations. Well, they run it, and there's little transparency, and we also can't influence them. So operationally, they're a centralized operation decision making, right? How does Tether or Circle decide whether they're going to move more of their reserves to short-term T-bills or move to whichever bank, and how do they pick their banks, and are these banks secure? How they come to those decisions, none of those are made transparent, and obviously none of us can get involved. So those decision making are also centralized. So they have a decentralization score of 2. UST, ledger's decentralized, operations a little bit decentralized, right? Because most of the mechanisms are implemented in an open source way and executed on chain. So there's some operational decentralization, but the decision making seems to be mostly driven by Do Kwon, his decisions, and his influence over the ecosystem. So decision making decentralization, we gave them a 0 out of 3. Frax. Operationally, we feel Frax a little bit more decentralized than Terra Luna. There's more transparency, their Discord. So we give them a bit higher on operational decentralization, and also with their decision making. They've started their DAO effort. There's quite some discussions every time important decisions to be made, and so we also gave them a higher score. DAI is the best, right? DAI. Yes, everything, their reserve operations completely implemented using smart contract. Oh, this is in contrast to Terra UST, for example. Their Luna Foundation guards Bitcoin reserve. That part of the operation is completely manual. They haven't coded it into smart contract, right? So they have the highest decentralization level. So this is the chart comparing centralization and decentralization of the stablecoins, and then when we plot them out on the chart, then obviously upper right is the best. That would be a decentralized and risk segregated stablecoin. So first we have the US dollar, right? Which risk-wise is pretty segregated, but there's no decentralization. And then there are the centralized stablecoins, USDC, USDT, and BUSD. As such, they have a little bit of decentralization because the ledger is decentralized. The risk is segregated because they're collateralized by cash equivalent, but they're not very. But other than that, they're not. The operations not implementing smart contract, decisions not being made through DAOs. So on that front, they're not very decentralized. And then we've got UST, which is a little a little towards a little more decentralized because their operations are somewhat decentralized in smart contract. So they're a little bit more decentralized than USDC, USDT. But risk segregation is really, really bad, right? Because they're entirely supported by their own endogenous token, Luna. And then, so the best, a good one would be DAI, which started in 2014 and have been through quite a few bearish cycles and have always held its peg. They're pretty decentralized at the same time because they're backed half by ETH and other crypto that's not correlated, not associated to the MakerDAO ecosystem in any way, and then half by USDC. We feel that they have a good amount of risk segregation. So that's how we plotted the chart. And moving on, I'm talking about specifically Terra's weakness, Terra UST's weakness. I'd like to refer to Professor Holmstrom because I think he elaborated best. XREX, we really understand a lot about money markets, but I like to reference his paper because I think he says it very well. So Holmstrom, he's currently with MIT. He won a Nobel Prize in economics back in 2016. He said money markets are about obviating the need for price discovery, right? You cannot, as a money market tool, as a stablecoin, you cannot allow too much speculation from the market against your system. So about obviating the need for price discovery using over-collateralized debt to reduce the cost of lending. So if you have over-collateralized debt, then of course, there's going to be less speculation and you're going to have much better liquidity. So I will argue that a state of no questions asked is the hallmark of money market liquidity. That this is the way money markets are supposed to look when they are functioning well. So this is in contrast to everybody asking for USDC's quarterly audit report and USDT's report. And recently USDC has announced that they're going to be moving to a weekly audit report publication model. I see that as introducing perhaps more trouble for themselves, because that is going to invite more market speculation and it's not good for their liquidity, right? So, here, let me read out more quotes. Opacity is a natural feature of money markets and can, in some instances, enhance liquidity. This blissful state of symmetric ignorance may be broken by public information that makes some traders' private information relevant, right? So, and here I want to talk about USDT and USDC. It's already harder to defend for USDT and USDC to defend against themselves, to defend their stable coins versus something like the US dollar or the new Taiwan dollar. Why? Because there's more transparency, right? So everyone right now is looking every day at how much total supply is Tether having and how much redemption is happening every day, right? So when it comes to liquidity, you can't reach a state of, in Professor Holmstrom's terms, symmetric ignorance. And so that is not good for liquidity. And so even for centralized stablecoins, they're already harder to defend versus traditional fiat money. And this is why in 2008, right? Remember the Lehman crisis, where all the banks were, sitting in closed conference rooms and said, "Oh, we're so dead, we really fucked this one up," and blah blah blah. And this led to Satoshi Nakamoto publishing his white paper or her white paper in October 31st, 2008, right? So that's the background. We are again today talking about the same thing. But anyways, so at that time, if you remember, Congress had to stuff money into good and bad banks, right? Now we know Wells Fargo never needed those billions in bail money, but Congress had to ask every single bank, good or bad, to take bail money in parallel together, because they cannot have market participants speculate which are the good banks needing not needing bail and which are the bad banks that needed this bail money, because then all of those capital sitting in the bad banks are gonna fly out, right? Or and they're all gonna have a bank run just because they took the bail money. So money market liquidity and defending against money is delicate operations that you're really playing a market confidence game, and it needs to be dealt with very deliberately and extremely quickly, which we felt that the Terra Luna organization had really could have done better this time. So finally, because Taiwanese, I like to talk about the birth of the new Taiwan dollar back in 1949. We have a book that I really like on Taiwanese history. In 1949, the Taiwan dollar collapsed because we were fighting a war. It inflated more than 9,000 times. And so we had to introduce new money. But how did we get people to buy into this new money, right? And the book talked about the huge success that the Taiwanese central bank had at the time was they allowed easy redemption of the new Taiwan dollar to gold, right? You have plenty of banks that allow you to redeem easily from Taiwanese dollar to gold. And so very, very quickly, then everybody stopped redeeming and then eventually stopped thinking about how much gold is back in the Taiwanese dollar. Why? Well, because, because you reached symmetric ignorance. People were ignorant about the fact, how much gold the Taiwanese central bank has, and they're even ignorant of the Taiwanese history, that in 1949, our money completely collapsed, right? And so that, for a money to function well and for it to have great liquidity, you need to somehow create this type of symmetric ignorance. All right, so back to Terra UST. And we're going to be talking about 3 weaknesses that Terra UST has. Number 1 is reserve weakness. UST is endogenously supported by Luna only, right? So mechanics-wise, a drop in UST supply is going to lead in a drop in Luna price. That's just mechanical, right? And that's not good, because with this design, first, you've opened up another vector of speculation, right? Stablecoin, everybody is going to speculate on your supply, how much outstanding you have. But then you've introduced another front of speculation, which is your Luna price. But at the same time, mechanism-wise, anybody dumping UST is going to cause Luna price to drop, right? So a death spiral we can say is just inevitable, because Luna supply drop leads to UST supply drop leads to Luna price drop leads to market confidence drop. Okay, and so I was when it just a little bit, I posted on my Facebook, because previously we were almost always the first in the world to post about the stablecoin depegs, and they have different issues. So I was there witnessing Beanstalk's hack, also there to see USDN's drop. And then so when UST depegged a little bit, I already posted on my Facebook, and at that time people were saying that it's just going to come back, right? But then I was watching, and we saw finally the deadly crossover, and that's when Luna's market cap dropped below UST's market cap, right? So then at that time, unless you had 20 billion, you had money equivalent to your entire market cap to defend. Otherwise, it's beyond safe. Okay, so that's Terra UST's reserve weakness. Moving on to their liquidity weakness, because liquidity, you can get away with very bad reserve, and we've seen plenty of central banks do this. by having great liquidity, right? When you have great liquidity and people feel that they can always convert and the store of value is holding, then they don't think about your reserve. Your reserve is they're going to be ignorant. And Terra UST had a $3 billion liquidity defense budget, which was good, but it's lower, right? So they had an 18 billion market cap for their money, so that's 17%. Usually central banks would have 25 to 35%. Taiwanese central bank has a lot more. And your foreign reserve has to be your first line of defense. And this cannot be gold or oil or hard assets. That's kind of your last line, right? So the already insufficient 3 billion defense budget should have been in USDC and USDT because that's the foreign reserve, right? So when people dump your UST, what are they looking for? They're looking for converting into USDC and USDT, right? So let's just assume that back then when they liquidated Luna and they had 3 billion defense budget, if they had split that into USDC and USDT, let's say 1.5 billion each, and they piled that in directly into curve pools, right? So that's telling people, well, here's my defense budget, it's 3 million. So under 3 million dump, you can take your money directly from the curve pools, right? You don't like our UST, fine, right? Go convert it in the curve pools. We've got 3 billion there piled up for you, plus 1.5 million of our own UST. So that's 4.5 billion of liquidity debt for you guys to convert. And if it's within this 4.5 billion of conversion, Luna is not going to get affected, right? Nobody's going to burn Luna because it's just our liquidity pool that we built. In contrast, Fei and Frax, I'd say, and especially Fei, they're both liquidity experts. They really know how to market make and use good liquidity as the first lines of defense for their respective stablecoins. And when they were building the forward pool, I feel that they could have considered loaning more USDC and USDT, right? Because at that time, Luna's market cap was good. So you use Luna, you take a loan, you loan out, let's say another 4 billion, 3 billion to build the new forward pool. And then you retract your capital from free pool because this time the quote unquote attacker, triggered their attack 4 minutes after the LFG pulled funds from their UST3 pool, right? So, but then they could have taken a loan from an exchange, an OTC desk, and just built their 3 pool first, built their 4 pool first, then retract capital from their 3 pool, pay the loan back. Okay. And then finally, they really should have acted a lot quicker because there was a period of 3 to 4 days before they started to liquidate their Bitcoin. So we have the timeline. And you can see, right, it's around UTC time, March 7th, when they started to depeg, and I voiced concerns on my Facebook, and we really saw the massive sell-off, which triggered a USDC USDT depeg. So if you remember the short USDT depeg, that was actually USDC appreciating in our point of view because the BTC was dumped against a USDC quoted order book. But that was 3-4 days later. Okay, so that was their liquidity weakness. They could have used liquidity better as the first line of defense. And finally, their demand weakness, right? So we have our head of risk at XREX is Michael Xing. Before joining XREX, Michael worked for 11 years at the US Fed in risk, doing risk analysis. So as soon as USDT also detected a little bit, he asked internally the question, hey, should we lower our USDT positions? How much lower can we go? Can XREX survive without USDT? And everybody's answer was no, we cannot afford to not use USDT. Why? Because in trading, USDT is at any times 10x better liquidity compared to USDC, and we just cannot get that type of liquidity holding USDC. So we had no choice, although USDT pegged a little bit. Of course, we did all of our analysis, and we kind of understood that it was because of the BTC dump. But still, that time we all realized that, hey, none of us held UST. Our exchange never listed neither Luna nor UST because of our research. But had we held UST, we could have just stopped. There's no stopping. Nothing stopping us from dumping UST. But Tether USDT, we needed to use it, right? And we saw this in how the industry bailed out Bitfinex and Tether back in May 2019, and that's when they had 850 million stuck in a Panama bank, and SEC had issues with his money hold. So in 10 days, Bitfinex raised 1 billion using a Leo token. It's just the industry bailed them out. Why? Because they had created solid demand for USDT, and the industry can't without them. Can't really operate without them. So we can also ask the question, can DeFi survive without USDC? And here I also feel that USDC has built up quite some significant hard uses. For example, DAI is 51% backed by USDC, FREX is 87% backed, right? And also there's some pretty deep liquidity pools in the DeFi ecosystem that participants rely heavily on. So USDC has also built up its solid demand. And
sorry,
we can also ask in the world.
Wrap up,
yes.
And there are some questions for you in the chat.
Okay, so I can wrap up. I'm pretty much done. So we talked about 3 types of weakness: reserve weakness, liquidity weakness, and demand weakness today.